Hello everyone, and welcome to this General Index and Sparta webinar, European Gasoline Premiums, What's Driving the Surge? Joining us as speakers today are Saket Vemprala, MD Markets for Europe and Africa at General Index, and Jorge Molinero, the commodity owner, light ends at Sparta. We'll kick off the webinar in just a moment, but first a couple of housekeeping items. Firstly, the webinar is being recorded and will be made available to you after the event. And secondly, we'll be holding a question and answer session after the webinar. However, please feel free to ask any questions during by using the Q&A function at the bottom of your screens. So without further ado, let's get started.
Thank you, Andy, and hello, everyone. Good morning to those of you in the UK and a good afternoon or evening to those of you dialing in from the continent or the Middle East or Asia. Thank you very much for joining this webinar from General Index, partnering with Sparta. Our topic of discussion today is the latest developments in gasoline, and in particular, what appears to be some quite notable strength in spot premiums for barges in the ARA region. Kicking things off, I thought we'd take a step back and have a look at gasoline cracks in context. It's no surprise for those of us who've been watching the market in recent weeks that there's been a fair bit of strength in cracks at the moment. As you can see in the light blue line in the chart on the screen, cracks are now well above their 5-year seasonal average and indeed well above where they were at this point last year. In a few seconds, we'll be diving into some of the fundamentals behind this move. But it's quite clear that we're in a situation now where firm demand is meeting tight supplies. We've got relatively low inventories in the Atlantic Basin, particularly in the PAD 1 region, week-on-week declines in inventories in the ARA, independent inventories in the ARA region. And you have an interesting situation where gasoline cracks are quite firm against a backdrop of firm diesel demand as well. So refining margins generally are looking quite strong and profitable at the moment. Having a look at some of the spot data which caught our eye in the past week, and indeed the genesis of this webinar was some pretty eye-popping premiums to front-month swaps for Eurobob spot barges as observed in trading activity. And so in order to highlight the strength that we saw in those premiums, I decided to construct a scatter plot that you can see on the screen in front of you. And so these are all the Eurobob average traded premiums or discounts to the front month swap since the beginning of last year. You can see a heavy concentration around the kind of plus 20 mark or just slightly before. We typically see barges trade at premiums in the low double digits to front month swaps typically. But then in the last week, middle of last week, we saw transactions soar significantly. In the top right corner, I've highlighted trades, average traded premiums Wednesday and Thursday of last week to the front month swap at well over $80 a ton, which was quite notable. And against the backdrop of firm fundamentals for gasoline, we thought interesting to have a look at what's driving this. And indeed over here, the fact that this is driven by firm demand and relatively tight supply is evident in the price formation. And so if you look at the dynamics over the course of last week in the barge market, I thought it might be interesting to demonstrate the extent to which buyers and sellers had to move towards each other in order to be able to transact. And what you see over here, particularly in the orange bars, is the extent to which bids moved from the opening bid levels to the transaction point, and the extent to which offers moved down from the opening offer levels to the transaction point. And those are the blue bars. And what's very clear over here is that particularly in the middle of the week, you started to see buyers having to move up quite significantly, in some instances, $30 to $35 a ton from the opening bids to meet the transaction level, whereas the blue bars indicate that the sellers had to move much less. Indeed, on Wednesday for E5 barges, sellers didn't have to move at all, and on Thursday for E10. Some of that steam might be coming a little bit out, particularly of E5. As you can see, sellers had to move more than buyers for transactions at the open on E5, but nonetheless, I think a sign that some of the wider fundamentals in the market were filtering through into prompt barge activity the ARA region. And so zooming out a little bit to consider what some of the fundamentals might be that are driving this. I mean, it's no surprise that from a refinery perspective, a fair bit of autumn maintenance and outages have fed into this. We have everything from the Totsa's Antwerp refinery in Belgium to the largest refinery in Europe, Shell's Pernis in the Netherlands. With its planned maintenance, you've got reduced throughputs from Preem in Sweden. And there's also, I think, the cumulative effect of refinery shutdowns here in the UK. Back in the spring, we saw Petroenios idle the Grangemouth refinery. And then, of course, over the summer, all of us saw the dramatic collapse of Prax and the resulting shutdown of operations at Lindsey refinery, which means the UK is now down from 6 to 4 refineries in the space of less than a year. I've pulled some data from Vortexa to show the impact that this has had on gasoline flows and also flows of components into ARA, and a general decline over the course of the autumn months as some of these maintenance and outages at various refineries is starting to feed through into the flows of gasoline and components coming into the key blending hub of ARA. The big story, of course, is what's happening in West Africa, and significant demand from West Africa pulling gasoline from ARA into that region. If there's one refinery that's dominated analyst discussions over the course of 2025, it is, of course, Dangote in Nigeria, whose residue fluid catalytic cracker unit has had some issues over the course of this year. We had an outage back in the late summer to early autumn. There's now talk of the unit shutting down again towards the end of the year in December, going into January, possibly alongside a CDU shutdown as part of a debottlenecking project. And demand has been firm. Part of that was given a boost by some talk of import tariffs being placed in Nigeria on gasoline imports, which we understand has now been either postponed or called off, as well as firmer demand heading into the Christmas period. Meanwhile, inventories offshore Lomé are recovering from one-month lows seen earlier in the month. And just for context, the data in the chart on the left shows volumes in transit heading to West Africa on a weekly basis. And so consistently for the last 5 or 6 weeks, we're looking at volumes in excess of 10 or million barrels in any given week on average heading into West Africa. And so on the supply side, you've got maintenance and outages in the Northwest European region, and on the demand side, you've got pretty firm demand from West Africa pulling volumes into that region. Some of this is having a spillover effect in some of the components markets, where on a range of different components, 99 RON Reformet, 103 RON Reformet, LCCS, toluene xylene, and winter non-oxy, all of which over the past week from pricing data that we've seen has enjoyed significant upswings of between 30 to 50%. These are the premiums to Europe swaps, as these components typically trade, all of which have enjoyed strength. Partly it's a case of buyers seeking to replace lost barrels from the maintenance and outages that we've been discussing earlier. And also it's a case of people looking to blend up to be able to cater to demand, such as we've seen in West Africa. And so we've now set in context at a high level what we think were some of the fundamental led factors behind the surge in premiums in Europe barges. But the key question, of course, that I'm sure everyone's thinking about is what comes next. And for that, it's my pleasure to bring in Jorge Molinero from Sparta. Jorge, over to you.
Hello, everyone. Thank you, Saket, for the overview, and General Index for inviting us to share our views on the market. And I'm gonna keep with the analysis of the gasoline market, especially with the IBOP. Why do we focus on IBOP for this webinar? I think we are in a very interesting moment. What Saket has just presented and what we saw during last week was kind of the physical reality matching the paper strength that we've been seeing in the market for a while. And to give you a measure of the current strength in the gasoline European market, IBOP cracks are trading at historical seasonal highs, not just in the prompt, but down the whole forward curve. So if you look at Q4 2026, the charts look similar and the values are historical seasonal highs. And this is not just specifically for Europe. We are seeing the same type of charts for Singapore and for the US. So RBOB and Singapore 92 cracks are also trading at historical seasonal highs. But why is EBOB most relevant right now? Because Europe is clearly outperforming US and Singapore market, and this is having a really bearish impact in TAR and in East West, which are reaching new historical lows. This is also impacting gas nap. We are seeing a very strong gas nap at the moment. It has been widening for the last few months, and right now it's at historical high levels as well. And this has had a very strong impact on blending margins. So here I show you the chart for E5 blending margin. So that's the margin of going to the market, buy the components at the spot price, and then sell them in the window. We've seen it open for E10 for a while and few opportunities for E5, as you can see. During last week it was open, but then after the last uptrend we've seen in components that Saket has shared, right now we find it close again. And what are the fundamentals that has taken us to this point with such a strong market? So I want to highlight one point on the supply side. I'm not gonna be very detailed on it because Saket has already mentioned it. But we've seen a very strong outages especially in Europe during the second half of this year. I think the first news we started to see them during the second half of August, but that has been the dynamic in the European market, and it has contributed to tighten the balance in Europe for all of these months. And then we have two factors on the demand side. The first is local demand. The demand for gasoline in Europe is quite strong. If you see the historical number is 8% higher than pre-pandemic levels. So the demand is strong locally. And then the main point behind all this uptrend, which is obviously West Africa. So to talk about West Africa, I think the market has changed a lot during the two halves of 2025. At the beginning of 2025, the market was pricing very few cargoes going from ARA into West Africa. We saw a very strong downtrend compared to previous years due to Dangote ramping up. But due to the several problems that we've seen in Dangote, we've seen an uptick in these cargoes, especially in October, and in November we will reach the highest level probably of exports from ARA to West Africa. So that's the main reason behind the strength in Europe at the moment, but it's also complemented by the other fundamentals that we've seen. Now, after this explanation about where we are now, I want to focus on the key points that we will be tracking in the coming weeks and months, and that we think that they could move the market. So first of all, doing an overview of the arbitrage picture, as we've said before, TAR ban is West at really low, and that is obviously harming Europe export potential. Together with the strength on TC2, it's making it also uncompetitive in the Atlantic Basin. So in this chart, we show a comparison of the delivery prices of different origins into different destinations. The lighter, the blue is the cheaper that barrel is, and you can see that Houston is cheaper right now, and it has been for a while, into almost any outlet in the Atlantic Basin, but Nigeria, that obviously belongs to ARA exporters. So we have that perspective on the arbitrage side. We don't expect a lot of support for ARA from the export point of view, but it will be compensated by the tight supply and demand balance at West Africa. Then we've seen E5 blend margin moving to E10. We've seen few opportunities where it has been open recently, but it has been impacted also by the strength in components. It's different than E5. It remains open, but it just remains open in the prompt for November blending and deliveries. And the margin is much weaker than what it was weeks before. And then one of the key fundamentals that completes the picture, together with the stronger demand, together with all the outages in Europe and with West Africa, are the tight stocks that we are seeing in the US. This is not just on the gasoline side, it's common for many products. If we check the chart for the total product stocks in the US, it's at the lowest point in 7 years, and the same for the gasoline stocks. Right now, they are particularly low in Path 1, but they have been very, very low also in Path 3 during the last weeks. And on the supply side, we've talked a lot about the current outages. I think the picture is less supportive because we will see some facilities coming back online, and this will bring gasoline barrels to the market. But we don't expect that to be a reversal point. I think we think that it will keep tightening the picture in Europe. So overall, the picture is bullish on the supply and demand side. And then I want to finish with a summary, the main points that we have been talking during this presentation, and the main fundamentals that will move the market. So first of all, the Atlantic Basin, the west of Suez, will remain tight on the gasoline side because of this tight supply balance and because of the low stocks in the US. We don't expect the bills that will come in the coming weeks will reach the average soon, so the market will keep supported on that side. And then a very interesting point is if you look out of the gasoline market, there is a strength that is also it's a fundamental strength that is impacting any product, not just because of the US stocks, but if we look at the different indicators for different products in different markets, we can see a very strong diesel cracks. We can see very strong jet as well, and naphtha it's also strong, especially in the mob market. So it's a fundamental strength that is impacting all the product, is impacting our margins. So basically, we are getting a fundamental signal from the supply side that we need more product in the coming months, and we need refineries to keep running hard. And the last point, we've gone through the main points in the gasoline market in Europe. We've touched the common points with some other products. And coming back to gasoline, we think that there are some opportunities for this strength in the European market to spread across the different gasoline markets in US, because we are seeing a lot of exporting opportunities with very tight gasoline stocks, and also because ARA is not going to be able to provide some outlet that belongs to the West, like East Africa, for example. So that means more opportunities for export could arise for Singapore and especially for AG barrels. And that has been all on my side. Happy to answer any question. If you have it, you just can type it in the chat and we will reply them. Thank you.
Thanks very much, Jorge. I was just reflecting on the last point that you were making in that slide over there. I mean, do you think to some extent RBOB is going to have to firm significantly if it needs to be able to overcome both tight stocks in Pad 1, but also to be able to encourage refiners to start increasing their gasoline production? Because, you did mention, and it is a fair point to mention, that we are going through a period of strong diesel strength. So in order to encourage and incentivize refiners to switch back, we will have to see much stronger US pricing. How likely do you suppose that is?
Yeah, I think it's a very interesting question. We've been talking about it for a while because we were showing at the same time a very strong downtrend in the TAR paper. The arbitrage closed from ARA into Path 1, as you have said in the beginning of the presentation, but and a lot of opportunities for US Gulf Coast exporters. So I think it's hard to point in the short term to a ceiling for TAR in paper, but if US refinery system is not able to build stocks, especially in Path 3 and Path 1, it could find a bottom soon, because it's going to be very hard for the US to keep supplying all the Atlantic Basin outlets right now with better economics than ARA, and at the same time keep seeing the lowest stock levels in the last 7 years. So to summarize my view, I think, yeah, there will be a turning point for TAR, but we will have to wait for the next data on stocks to to measure it. Yeah.
That's interesting. So potentially some opportunities here for AG sellers looking to capitalize
Yeah.
on this tightness. We talked a lot about WAF. I mean, Nigeria is dominating things, of course, but recently we had the official inauguration of the new 30 kbd refinery in Angola. Obviously, it's significantly less capacity than Dangote or many other refineries, but
Yeah.
what are the expectations that the new Luanda refinery might help to feed into some of the regional West African demand?
Yeah. In the end, it means more local supply for West Africa, but I think we have to measure its impact later. Otherwise, it could happen like with Dangote. As I have said, the main the main point for EVOP complex strength at the moment is that West Africa supply haven't matched what it was expected. So during the first half of the year, it was supplied at a good pace. Lower imports were needed from ARA, but then
Yep.
suddenly you need a lot of cargoes from ARA, and that drives the paper higher, then it's translated into the physical, into components, into the barge market. So yeah, the idea is that it will be bearish, but Dangote was also really bearish for ARA, and we are seeing historical seasonal highs levels.
Yes. And I mean, you do make a good point because, to some extent, the webinar was prompted by, what we saw as some
Yeah,
unusual strength in the barge market. But of course, that's often the tail end of things that happen farther upstream. And as you say, it works its way through paper and components before eventually manifesting itself in the barge market. But it's
yeah,
it's nice to have the opportunity to be able to connect all of that together in one place. I might hand things over to my colleague Andy, our organizer, to see if we have any questions coming in from participants.
Thanks, Jorge, and thanks, Saket. Yes, while you guys have been talking, we've had somebody ask, how do you think the 21st of November deadline for sanctions on Russian companies will affect their naphtha, and as a result, the gas/NAP spreads?
yeah. I think well, we already saw the impact on the naphtha market. The same day we were in contango in Europe, and the same day that we saw the announcement of the sanction to Rosneft and so on, naphtha European market went into backwardation again. MOBJ crack went into positive values a few days later. So we saw a very prompt strength by just the announce of the new sanction. But overall, I think it's adding more fuel to what we are already seeing on the naphtha market. So East West is trading at record levels, prompt values and down the curve, and it means Asia needs more naphtha from the West. We have new additions for steam crackers in the East. It means more naphtha demand, and we have less options for Russian naphthas to find a home, or even less options to produce it um, in the Russian refineries. So Asia face a balance where they need more supply. They need more demand. They have more demand, and they potentially have less supply. So they need to pull barrels from the West, and that tightens the global naphtha picture around the world. And yeah, my expectation is that we will keep seeing it at least during Q1, and I would say Q2. We will keep seeing a very strong East West, allowing the arbitrage to flow from Europe and US Gulf Coast into Asian outlets.
It'll be interesting to see to what extent the trade-related or trade negotiation-related purchases of US LPG by India recently might affect some of that, because if you've got more US LPG, heading to India, a relatively rare arbitrage being driven by geopolitical factors or geoeconomic factors, does that mean that LPG that would otherwise have gone to Asian crackers might instead now be going to India, and so you perhaps more demand for naphtha to compensate for that?
Yeah, I think on that point, the trend is that we will keep seeing more US exports into India and overall into Asia. And if you look at PRONAP in the East, it's also at the lowest point for the last 10 years. So it means the market is pricing more supply in general from the US, and a biggest market share going into Asian outlets. And that is adding pressure to the propane Asian leg. And then on another point of the supply of the US, the stocks for propane and propylene are quite high in the US. So it's the opposite picture than in gasoline. And I think it's overall bearish for propane in Asia. Yeah.
Thank you, Jorge. Another question that's come in. What is the solver for the tightness outside refinery supply, and how much can aromatics help, and how much aromatics have we seen going into the gasoline pool?
Yeah, well, I think if we look some months ago, well, if we place ourselves in summer, part of the aromatics story that we were seeing during the previous years was gone. So when the conflict in Ukraine started, we saw a very escalation of all the aromatics products, translated into a strong gas nap, well, record level of gas nap, record level of components, and it was a stick to the market for more than 2 years. Then it started to fade, but what we have seen right now, it's this trend coming back to the market. So the less availability of Russian product in the Western markets, especially in Europe, helps to tighten the aromatic picture. And I think in the coming months, maybe during the whole 2026, we will keep seeing this. So we have like a new baseline for gas nap, a new baseline for aromatic components, and and I think we will keep seeing it in the coming months.
In the very short term, I mean, TX is one of the components that we did see quite a fairly big jump in the past week in premiums to EBOB, which I guess highlights the point that you're making.
Yeah, and Refor make too, C5 naphtha as well. So we have several components that have jumped in the last couple of weeks.
Yeah. So aromatics helping to solve the issue somewhat.
Fantastic. Thanks very much, Saket. Thanks very much, Jorge. That actually brings an end to our Q&A session and indeed to the webinar. Thank you all very much for attending. We hope you found it informative and useful. Once again, it's been recorded and will be made available for you to replay very shortly. Thank you again for joining us today.
Thank you very much.
Thank you. Bye-bye.